Hi, I'm Wal Galbraith. I'm a part of the Ray White South Coast Group, and this is your South Coast Snapshot for Week 10, 2023. The Snapshot is designed to give you a bite-sized breakdown of the real estate market overall, including local, regional and city-based information across Australia. All information is sourced from the AFR, leading economists on Twitter, and the Sydney Morning Herald. All information is relevant to buyers, property owners or both. Wages growth is tipped to have accelerated to its fastest rate in a decade at the end of last year, cementing the prospect of at least 2 more interest rate rises from the Reserve Bank of Australia. Markets expect the December quarter wage price index to be released on Wednesday. Will show pay packets grew by a solid 1% in the final 3 months of last year, taking annual growth from 3.1% to 3.5%. It would be the fastest rate of annual wages growth since September 2012, when a boom in commodity prices stimulated the economy, fattened pay packets. Unit prices have plunged back to or below pre-pandemic levels in almost 140 Sydney suburbs, while house price growth has dropped in almost 60. The biggest house price declines are in the city and inner south, but unit declines are more widespread. While prices are lower, experts say affordability has deteriorated as interest rates rise. Rising interest rates for local investors and higher costs for overseas buyers are pushing developers away from residential projects targeting landlord buyers, which will worsen the current rental shortage as demand surges on a rebounding international migration, a new survey shows. Heavy rain meant the number of residential properties Stockland settled in the December half fell to 1804 from 3815 a year earlier, a result similar to outcomes seen across the listed property sector this reporting season. While the company has now cut its full year target from 6,000 lots to 5,500 lots, Gupta will need plenty of sunshine and no supply chain hiccups to deliver. Sales of new lots were also soft as rising rates and falling house prices battered buyer confidence. Soaring residential rents are unlikely to peak until early next year as the chronic shortage of rental homes amid surging migration is expected to persist over the next 12 months, according to Westpac. Westpac Business and St George senior economist Pat Bustamante said the current rental crunch was likely to be longer and more severe than the previous cycles, as demand vastly outpaces supply. Given the current supply and demand dynamics and the lag in supply, the peak would likely take longer than people expect, Mr Bustamante told the Australian Financial Review. Westpac predicts advertised rents to rise by 11.5% this year, the sharpest annual increase on record. Now, this would take the average asking rent nationwide to $633 a week, or an additional $65 per week. This could be enough to entice investors and developers back into the market, which would ease some of the supply crunch, they've stated. A shortage of homes for sale in Sydney has helped limit falling prices as sellers hold off listing properties until the real estate market improves. The number of properties listed for sale in January was down by more than a third year on year in some regions and by more than 10% across most of the city, Domain data shows. New listings in most regions were also lower than January 2018, when the market was in the midst of its previous downturn. These lower listing levels have led to increased competition on the properties that are for sale, despite rapidly rising interest rates. Almost 50 lenders are offering incentives ranging from 3 years of free NBN access to $10,000 in cash in an aggressive bid for market share on a scale not seen since the heady days before the global financial crisis. The intense competition has driven some banks to write unprofitable loans and some borrowers to refinance within a year just to take advantage of the cash-back offers. It comes in unprecedented circumstances, with few new mortgages being written, but about $320 billion in loans taken out at a time of ultra-low interest rates, and before the Reserve Bank raised the cash rate 9 times in a row, needing to be refinanced this year. The Reserve Bank of New Zealand slowed the pace of its policy tightening as Governor Adrian Orr warned that the devastation caused by severe weather will worsen inflationary pressures and hit economic growth, complicating its fight against surging consumer prices. New Zealand's central bank lifted the cash rate by 0.5 percentage points to 4.75% on Wednesday, in line with economic expectations. The RBNZ even considered a second consecutive 0.75 percent point increase. The New Zealand dollar firmed to 62.26 US cents after the decision. Seeking potential refinance options for yourself? Reach out so we can get you in touch with our in-house loan market mortgage broking specialists. Looking to make the best use of the current marketplace? If you're either expanding your property portfolio or looking to sell your property, get in touch today. We'd love to help. I'm Wal Galbraith with the Ray White South Coast Group, and that was your South Coast Snapshot for Week 10, 2023. Be well, see you next week.